Hey, what's happening, guys? Dan Darrow here with another Options to Play video update. So today's video is going to talk about something that if you're in the VTF, you've probably heard me talk about before. Uh, if if you aren't, it might be something that you see that shows up in my position list. And what I want to talk about is what I call like fast hedges or quick hedges. Um, I mean, obviously, a hedge is. I consider a hedge to be different than a strangle or a straddle. Uh, so a hedge, much smaller, almost like an insurance trade, right? So whereas a strangle or a straddle, I want directional exposure both ways, right? I think that there's a reasonably good chance that there is a pretty significant move one way or the other. With a hedge, it's a little bit different. It's like yes, it is kind of similar to a strangle in the sense that you're trading in both directions, but I typically view hedges as lower debit bets with like with a primary bias one way, right? So taking AMBA here as an example, right? Going into earnings, we were looking at the long a long trade into this because of this really nice setup here, right? It was flagging into like this 40 multi-month resistance, coming off a quarter where it had a pretty big pop and run. So got a little momentum from last quarter, technically pushing up into a pretty key area of resistance, and I felt that if it was good again, that it could really trigger this significant breakout here, right? And you could see a move up into like this gap from June, right? So the trade was the long April call into the report. So what happened was this morning, right? So what happened was like this morning the stock popped and took off and then ended up stalling around 45. And during like that the morning, the averages which had opened just about flat started to sink. Right. Let's put this up here. Can't really see it, so let's do this. Um, so it's a little bit tougher to see, but what you can notice here is that the averages started to roll over basically right after the open. It was kind of like a flatter open, and then they started to sink and picked up a little bit of a speed lower during the morning. And uh, what I like to do, so it's this one. I'll talk about Amber and I'll talk about MEL Live from last week. So what I like to do is when it's like a directional bet into a report, right? So say like for instance, Amber was like a long call into the report, right? And you get a nice big gap. Um, Sometimes, I mean, like the reasons for this will differ, right? So AMBA was because the market was starting to weaken, so it was a pretty significant gap with kind of like a weakening tape, right? We've had a really big run over the last 2 months. We're looking a little toppy, a little bit more cautious here, thinking that we could be due for a little bit more of a pullback. So when I saw the market start to weaken, I was worried about AMBA's like sizable gap, right? So what I like to do in those cases is target like a fast hedge, so like an intraday hedge, and what that is kind of similar to like the hedging strategy overall. It's like something that's like 20 to 30% of like the net debit of the trade or the current debit of the trade. So looking for maybe some maybe a put position, maybe either on the weekly contracts or the next week contracts, something shorter term, just as basically like a trade against like the big gap and the potential for it to roll over, right? And you're looking at like that 20 to 30% range, right, where it's low enough where if the stock continues, obviously the hedge is going to get hit, but it's a lower debit position where it won't completely skew the risk profile of the long, right? Versus like, if it gapped up and you put on a put hedge that was, at like maybe like 75, 80, 90% of the current debit of the long call, then that kind of materially changes the risk, right? So then it turns more into like a strangle, which is like a different trade completely. So it's basically like these fast intraday hedges. Sometimes you can, you're just kind of like in and out, right? Like if it doesn't really pull back or if it doesn't really move against the gap, then you could close it out, or if it ends up moving, then you could either like hold on to it for the rest of the day or the next day or however long you want. But it's basically I'm sure you've seen it like pop up in my position list, and it I tend to do this on stocks that have big gaps. Because a lot of times the spreads on the options are wide. The options of the stock can like really be swinging around pretty wildly, so it makes it very difficult to get out quickly off the open on some positions when you get these big gaps. So I like to do it just in case you get a move against it, and it gives you like a little bit more time to be patient and wait for like the spreads to tighten. Focus on the prices you want, right? And I wanted to like mention with MEL Live from last week. So this also kind of arises with more complicated. So strategies where it's like spreads, flies, right? So last week you had MELI had like this monster gap, right? And like open blew through the top of like the spread, and obviously like it falls into like the mega gap category. Like the issue with that is like when you have like a multi-leg strategy, so like spreads, flies, something where it's you need to like close like multiple contracts at once, especially on something that had a huge gap and has a little bit wider spreads on a normal basis. I mean, just the contracts and the speed of the stock moving can make it really, really tough to get filled. So this is one where I decided to do like kind of like a fast hedge against it, and it's really just because like the spreads when they had like the monster pop, like the spreads were a little bit wider, and it was just a little bit more challenging to get like like the midpoints with things like flying around so much. So it's also like something. So instead of just a big gap, and I think like maybe it'll pull back. It's also when there's like a big gap, and I have like a multi-leg strategy. Sometimes like I'll throw on like a fast hedge just until like the spreads tighten and I can get filled at prices a little bit more reasonable versus like paying like a wide paying like the offer on like a wide spread and hitting the bid on like a wide spread, something like that. All right. So again, it's just something like I talk about in the VTF a lot. I've had questions about it in the past. I actually haven't done a video on it, surprisingly. And I was thinking about it today because it was something that came up with Amberella, AMBA. So I wanted to just kind of lay out my reasoning, my rationale, why I do those, just in case you have any questions on it. All right. As always, I'd love to hear from you guys. Questions or comments, definitely reach out. I hope you have a great night, and I'll talk to you guys in the morning.